This wasn't a gold headline pop. This was the rates market blinking and gold front-running what comes next. Overnight, while most people were staring at the surface story, gold surged through a level the market treats like a psychological tripwire, and the entire macro complex had to reprice in real time. And you're going to hear the usual dismissal. It's just geopolitics. It's just the dollar. It's just fear. That's the comfortable narrative because it lets everyone pretend this move is temporary. But the uncomfortable truth is mechanical. When rate cut odds reprice, especially at the front end, gold doesn't ask permission. It reacts to the math, the hedges, the funding, the positioning, and the timing. And if you want the real edge here, it's not simply watching spot gold. It's watching the pressure points around it, because that's where the next forced move will start. Here's the tape, stripped of excuses. Gold didn't just drift higher. It popped fast enough to change behavior. A move like that doesn't happen because retail suddenly got spiritual about hard money at 2 a.m. It happens because the market's internal incentives changed. Dealers adjust hedges. Funds adjust duration exposure. Risk managers tighten limits, and the moment a widely watched level gives way, the market stops debating and starts doing. That's where the real pressure starts. Now, let's name the conflict, because the conflict is the whole story. There's a force in markets that always tries to suppress the idea of regime change. Not a cartoon villain, not some smoky room, just incentives. Institutions are paid to normalize. Politicians are paid to reassure. Strategists are paid to explain yesterday's move with a headline that sounds tidy. Gold is up because X. But when the driver is rate expectations, when the market starts to believe cuts are coming sooner or deeper or simply more inevitable, that's not tidy. That implies the economy is bending. It implies debt math is biting. It implies policymakers are constrained. And once that thought takes hold, gold becomes a currency alternative again, not a commodity chart. But that's not the part that matters. The part that matters is what happens after the first pop, because the first pop is the invitation. The follow-through is the verdict. And follow-through in gold is rarely about one thing. It's a stack. It's real rates. It's the dollar. It's global bond yields. It's physical procurement. It's futures positioning. It's options reflexivity. It's whether liquidity thins at the exact moment everyone needs to adjust at once. And this week, right now, you have that combination. The next detail is what flips the whole setup. When people say rate cut odds repriced, most hear a vague idea. Maybe the central bank will be nicer. That's not how markets work. The market doesn't wait for the rate cut to happen. It prices the path. It prices the probability distribution of outcomes. Fed funds futures, the front end of the curve, short-dated interest rate swaps, those markets are basically a live scoreboard of what traders believe the policy rate will be. When those probabilities move, it changes the discount rate on everything. It changes funding costs. It changes hedging costs. It changes which trades blow up and which trades get a second life. It changes the cost of carrying risk. And gold, an asset with no yield, feels that instantly because its competition is cash and short-term paper. If the market starts believing that higher for longer is cracking, the opportunity cost of holding gold drops in the mind of the marginal allocator, even before anything actually changes on a policy statement. Because if this one level breaks, the math changes. Now add the second layer, real yields. This is where people get sloppy. They'll say, rates down, gold up. But the real driver is not nominal rates in isolation. It's what happens to inflation expectations relative to nominal yields. If nominal yields fall because growth fears rise and inflation expectations don't fall as much, or if inflation expectations even tick up because fiscal and supply risks persist, real yields compress. Real yield compression is rocket fuel for gold because it means the market is paying you less in real purchasing power to sit in short-term government paper. And when real yields compress quickly, gold moves like it's snapping to a new equilibrium. Not gradually, suddenly. That's where the market can't unsee it. And then there's the third layer, the dollar. Yes, a weaker dollar often helps gold. But in moves like this, the dollar is frequently a symptom, not the original spark. When rate expectations shift, interest differentials shift, currency hedges shift, global capital reallocates. If the U.S. policy path looks less supportive, or if other parts of the world suddenly offer higher yields, the dollar can lose altitude. And because gold is priced globally in dollars, that altitude loss feeds through as higher dollar gold, even if gold's purchasing power in other currencies is doing something slightly different. But that's still not the hidden detail. Here's the hidden detail that reframes the entire story. The cleanest signal often shows up not in spot gold itself, but in the plumbing around gold, how the market prices time, delivery, and financing. In plain English, you want to watch whether the market starts paying extra for metal now versus later. You want to watch whether spreads tighten, whether the cost of carry behaves normally, Whether the forward curve stays in typical contango or begins to flatten, whether paper convenience starts losing to physical immediacy. You don't need conspiracies to see it. You just need to understand incentives. If immediate metal becomes more valuable, or if financing conditions become stressed, the market will tell you through structure first. And once you see that, you stop being surprised by pops. You start expecting them. Because the next move isn't T driven by opinion, it's S driven by what participants are forced to do. Let me make that concrete without drowning you in jargon. Gold trades in multiple forms: spot, futures, forwards, options, ETFs, physical bars and coins, industrial demand, central bank reserves. These are connected by arbitrage, traders who buy one form and sell another to lock in tiny spreads. In normal conditions, that arbitrage keeps prices aligned. Futures usually trade a bit above spot because there is a cost to carry metal over time: storage, insurance, and the financing rate. That's why gold often sits in contango. Later delivery costs a bit more. But when something changes, when there's urgency for near-term metal, or when financing becomes tight, or when the market is bracing for a volatility spike, those relationships can distort. And when they distort, participants adjust. That adjustment can force buying. It can force rolling positions. It can force short covering. It can force dealers to hedge differently. And that's where the real pressure starts. Now, zoom back to the overnight move itself and ask, why did this happen now? Not last week, not next month. Timing is not decoration. Timing is catalyst. Right now, you're sitting in a zone where liquidity can thin, positioning can be crowded, and calendar effects can turn a normal repricing into a violent one. You have a central bank communication window where every sentence is parsed. You have month-end behavior, funds that rebalance, risk models that reset, option books that need adjusting. And you have a market that has already been trending higher, which matters, because trends create complacency right up until a breakout forces everyone to stop being complacent at the same time. The calendar is the catalyst. That's the part most people miss. Okay, so what proof do we have that this isn't just an emotional spike? You don't need one proof point. You need a stack, because markets are complex and the best trades are supported from multiple angles. First proof, the very concept of rate cut odds repricing implies the front end moved. You can see this in how traders talk about probabilities and paths rather than certainties. When those probabilities shift, the entire curve doesn't need to collapse. Just the front end moving can change the gold calculus. Second proof, the dollar reaction. If the dollar was offered during the move, that's consistent with shifting rate expectations and global capital rebalancing. Third proof, cross-metal confirmation. When silver and other precious metals move in sympathy, it suggests a broader hard asset bid rather than a single idiosyncratic flow. Fourth proof, the chart behavior. A clean push through a major round number isn't only technical theater, it's where stop orders, risk limits, and systematic strategies tend to cluster. Fifth proof, institutional behavior. ETFs and large allocators don't always move first, but they amplify when momentum and narrative align. When those flows turn from bleeding slowly to absorbing, price discovery changes. The next detail is what flips the whole setup. And let's talk about chart structure, because this is where what happens next becomes visible. Round numbers in gold, especially a level like 5,000, are magnets and tripwires at the same time. They attract attention, they cluster orders, and once crossed, they often trigger a different kind of behavior. Instead of selling into rallies, participants start buying dips because they fear missing the next leg. That shift in psychology is powerful, but it's also dangerous, because it creates the conditions for volatility tricks. The market loves to break a level, run stops, and then whip back, because that's how it harvests emotion. If you've been in markets long enough, you know the feeling. You buy the breakout, it dips, you panic, you sell, and then it rips without you. That's not an accident. That's how volatility is used. And if you're going to engage here, you need a shield against that manipulation. Here's the shield, separate trend signal from noise. The trend signal is the market repricing the path of rates and the credibility of fiat purchasing power relative to hard assets. The noise is the intraday whip, the headline flicker, the social media hysteria, the talking head certainty. If the thesis is rate cut odds repriced and real yields compress, the confirmation isn't one candle, it's a sequence. Does gold hold above the broken zone on pullbacks, or does it immediately collapse back under it? Does the dollar remain soft, or does it rebound aggressively? Do short-dated yields continue to reflect easier policy expectations, or does the market snap back to higher for longer? Do spreads and structure stay calm, or do they start hinting at near-term tightness? This is not about predicting a straight lineup. It's about watching what the structure forces participants to do. Now let S address the part that makes people either euphoric or cynical, paper versus physical. This is where bad narratives flourish. You don't need to claim the futures market is fake to understand that paper flows can temporarily dominate price and physical flows can quietly set the floor. Futures are leveraged and liquid. They're where macro money expresses views fast. Physical is slower, but it's where real demand shows up. Jewelers, refiners, industrial users, central banks, long-term holders. When paper buying surges because rate expectations shift, it can push price quickly. When that happens, physical demand might pause because price is higher. That can create a moment where skeptics scream, "See, it's all paper." But then something else happens. If macro conditions remain supportive, if real yields remain compressed, if currency confidence remains shaky, physical demand returns on dips, and ETFs and longer-term allocators start treating pullbacks as entries. That's how a trend becomes durable. Not a single day, a rhythm. But that's not the part that matters. The part that matters is who gets trapped. Because markets don't move smoothly. They move by trapping people. And a gold breakout driven by rate repricing the trapped cohort is often the group that bet on strong real yields and a resilient dollar. People who were comfortable shorting gold as a no-yield asset in a world where cash paid you. If the market begins to price easier policy, that short thesis weakens. Shorts start covering not because they changed their worldview, but because their risk manager changed their tolerance. Margin requirements don't care about your thesis. VAR models don't care about your narrative. When volatility rises and price moves against you, you reduce exposure. That reduction is buying. Forced buying is different from voluntary buying. Voluntary buying can pause. Forced buying tends to cascade, and that's where the real pressure starts. But you need to keep your feet on the ground, because fast rallies can punish the believers too. If you're watching this move and thinking it guarantees a straight shot higher, you're setting yourself up to be used. A thesis can be correct and still deliver brutal drawdowns on the way. Gold can whip around violently even if the macro regime is shifting in its favor. That's why you need a two-scenario lens, simple, clear, non-emotional. Scenario 1 is the controlled pullback and retest. In this scenario, gold breaks the big level, runs a bit, then pulls back into the high 4,000s range, maybe the upper 4,900s, testing whether buyers actually show up. The dollar stabilizes but doesn't rip. Front-end rate expectations remain softer than they were before the pop. Volatility cools. This is the market converting a breakout into support. It feels boring compared to the overnight spike, and that boredom is exactly what flushes out weak hands. If that retest holds, it's constructive. It tells you the bid is real, not just a squeeze. Scenario 2 is the continuation squeeze with gap risk. In this scenario, the market doesn't give you the polite retest. Liquidity thins, positioning is forced, and gold starts gapping higher in bursts, especially around key events and calendar moments. In this world, the headlines will chase price, not lead it. You'll see panic buying in the wrong places. You'll see dip buyers get rewarded instantly, which reinforces the behavior, which reinforces the trend, which creates reflexivity. And reflexivity is dangerous because it ends only when something breaks. Either the macro driver reverses, or the market becomes so one-sided that it runs out of incremental buyers. The next detail is what flips the whole setup. So what confirms which scenario you're in? Start with the front end. If rate cut odds truly repriced, you'll see it persist in the way markets talk about the path. Less confidence in restrictive policy, more sensitivity to data, more pricing of easing over the coming months. You don't need exact numbers to respect the signal. You need direction and persistence. Second, watch the dollar. If the dollar bounces hard and sustained, that's a headwind. If it stays heavy, that's supportive. Third, watch gold's behavior around the big level. Markets love to punish crowds. If everyone decides 5,000 is now guaranteed support, the market will try to shake them out with a nasty dip. That doesn't mean the thesis is dead. It means the market is doing what it does. The key is whether that dip is rejected. Fourth, watch the structure and the plumbing. Is the curve behaving normally? Is financing calm? Are spreads stable? If the plumbing starts to stress, that can accelerate upside, but it also increases volatility risk. Translation, you can be right and still get chopped if you've done T-size and plan like an adult. Now, let's talk about the mainstream narrative you're going to hear over the next several days, because knowing the narrative is part of your psychological shield. If gold stays elevated, the story will become safe haven. If it pulls back, the story will become profit-taking. If it rips higher, the story will become fear is spiking. These are not explanations. They're labels. They're designed to feel explanatory without giving you mechanism. And mechanism is what you need, because mechanism tells you what to watch next. Here's the mechanism. When policy expectations shift, the market reprices the discount rate and the perceived stability of currency purchasing power. Gold is the asset that says, I don't trust the path you're on. And when enough capital starts to agree with that statement, it doesn't need constant news to keep rising. It needs persistent conditions. Real yield compression, dollar softness, fiscal anxiety. geopolitical uncertainty, and crucially, the market structure that amplifies all of it through hedging and positioning. But that's not the part that matters. The part that matters is what the move forces participants to do this week. Think about the players. Trend followers and CTAs respond to price and volatility, not opinions. A breakout through a major level can flip their signals from neutral to long, especially if it holds for a few sessions. Macro funds look at the rate path and the dollar. If the market is pricing easier policy and the dollar is weakening, gold becomes an expression of that regime shift. Dealers manage option books. When price moves into zones with heavy open interest, dealer hedging can amplify moves. Physical buyers are opportunistic. They often buy dips, not spikes, but in a regime shift, they become less price sensitive because their priority is securing exposure, not optimizing entry by $10. And then you have the cautious crowd, the skeptics, who don't want to believe. Ironically, skeptics are fuel, because the longer people refuse to believe a trend, the more underpositioned they are, and the more they have to chase when the market keeps going. That's why disbelief can be bullish. It keeps the trade from becoming fully crowded too early. But let's be honest, gold at these levels also invites counterpunches. The counterpoints are real. If policymakers communicate no rush and the market believes them, rate cut odds can reprice back the other way. If inflation data surprises hot, real yields can rebound. If risk assets rally hard and liquidity flows back into growth, gold can pause. If the dollar catches a bid because global stress drives demand for dollar liquidity, gold can get hit in the short run, even if the long-term thesis remains intact. And if the overnight pop was driven partly by position adjustments and thin liquidity, you can absolutely see a sharp retracement that feels like betrayal. That does not automatically invalidate the regime shift. It tests it. And the test is where disciplined people separate from emotional people. Because if this one level breaks, the math changes, either in your favor or against you. So here's a grounded way to think about levels without pretending we can predict tomorrow's exact print. The big level is 5,000. Above it, psychology shifts to buy dips. Below it, psychology shifts to, was that a blow-off? If gold can hold the area just under and around that level, call it the high 14,900s, on a pullback, that's constructive. If it slices back down and can't reclaim it, the market is telling you the move was premature, at least for this week. On the upside, the next zone is the early $5,100s, where you'd expect sellers to test the market's conviction. Not because sellers are evil, but because that's what markets do. They probe, they search for weak hands, they test liquidity, and every test teaches you something about who is really in control. Now let's turn that into a practical what to watch next checklist. Simple, mechanical, and useful. First, watch the front end of rates. Do expectations stay tilted toward easing, or does the market snap back to restrictive policy? Second, watch the dollar reaction. Is it making lower highs, staying heavy, or reversing sharply? Third, watch gold's behavior around the big level. Does it reclaim quickly after dips, or does it struggle? Fourth, watch volatility. Are moves becoming more gappy and unstable, or are they smoothing out? Gappy and unstable can mean squeeze dynamics, but it also means the market is dangerous for undisciplined sizing. Fifth, watch confirmation across metals. If silver and others remain supported, it suggests a broader hard asset regime bid. If gold is alone, be more cautious about calling it a durable trend. And that's where the real pressure starts, because the market will give you the answer if you stop demanding certainty and start reading structure. Let's address the emotional trap right now, because I can already feel it in the crowd. When gold makes a dramatic move, people get pulled into two extremes. One extreme is euphoria. This is it, the final breakout straight to the moon. The other extreme is cynicism. This is manipulated, it's fake, it'll dump, don't bother. Both extremes are emotionally satisfying, and both extremes can get you hurt. The disciplined middle is less exciting but more profitable. Accept that volatility will try to make you abandon your plan, and design your plan so volatility can't control you. That means you respect the trend signal, but you don't marry the exact entry. You recognize that a correct thesis can still include nasty shakeouts. You define what invalidates you, not what scares you. You size so you can survive the whip. Because the market's favorite trick is to shake you out right before the move you were waiting for. And the next detail is what flips the whole setup. Now, I want to return to the hidden detail one more time, because it's the part that will keep you ahead of the headlines. The headlines will talk about politics, turmoil, safe haven demand. Those may be true, but they're not actionable. The actionable signal is whether the market is pricing time and metal normally. If gold remains in a healthy, normal carry environment and still holds above major support, that suggests the move is being absorbed without stress, often a sign of durable demand. If the market starts showing signs that near-term metal is prized, flattening of the curve, tightness in financing, unusual spread behavior, that can indicate acute demand or stress, which can fuel continuation but also magnify risk. In other words, structure can warn you about both opportunity and danger. It can tell you if you're looking at a steady bid or a pressure cooker. And pressure cookers don't release steam gently. They either cool down or they blow off in bursts. So where does that leave us right now today? It leaves us with a market that has crossed a psychological threshold and forced participants to update their assumptions. It leaves us with a narrative war, headlines versus mechanics. IT leaves us with a calendar window where liquidity and positioning can make small repricings turn violent. And it leaves us with a simple but powerful map. If the front end remains priced for easier policy and the dollar doesn't reclaim dominance, gold has room to stay elevated and potentially extend. If the market reverses that repricing, if rate cut odds snap back, if real yields rise, if the dollar rips, gold can retrace hard and fast, especially after a sharp spike. Both outcomes are plausible. The difference is what confirms them. And the confirmation is not someone's tweet, it's structure. Here's the quiet warning that can save you money. Volatility will be used against you. If you're bullish, the market will try to scare you out with a sudden downdraft and a scary headline. If you're bearish, the market will try to trap you with a grind higher that feels irrational until it's too late. Your job is not to feel smart. Your job is to survive and execute. That means you don't chase and panic after a vertical candle. You don't short in anger because you missed it. You wait for your confirmation signals. You respect your invalidation level. You treat this like a campaign, not a lottery ticket. And you remember that gold can whip even when the thesis is right, because gold is where macro fear, macro liquidity, and macro positioning collide. So I'm going to leave you with targets and invalidation in a way that's honest. Upside targets exist because psychology and structure create stepping stones. If gold holds above the breakout zone and the rates repricing persists, the market will naturally probe higher into the next resistance zone above 5,000, where sellers will test conviction and buyers will have to prove they're not tourists. If that zone gets absorbed and the market stays in squeeze mode, you can see fast extensions that look ridiculous until you remember that forced buying doesn't exactly care about your disbelief. On the downside, the invalidation is simple. If gold can't hold the high 4900s on a retest and the front end snaps back to tighter policy expectations while the dollar strengthens, the overnight move starts to look like a temporary spike rather than the first chapter of a new leg. That doesn't mean gold is dead forever. It means this week's setup failed. And that distinction matters because it keeps you from turning a trade into a religion. If you're still here, you're part of the small group that cares about mechanism more than noise. That's the edge. Most people want a story, you want a map. Keep your eyes on the front end of rates, the dollar's posture, gold's behavior around the big level, and the structure that reveals whether the market is calmly absorbing demand or quietly tightening into a pressure cooker. And if you want to stay on the right side of these moves, don't just watch price. Watch what price forces other people to do, because that's where the next surge is born.